Security Bank on Tuesday published a report warning the U.S. may be heading towards stagflation. We've invited the author of that report for a chat on what would that mean for the Philippines. With us now for more is Security Bank's Head of Research and Chief Economist, Angelo Taningco. Good to have you back, Jello, and back so soon for urgent reason, but news could have been better. What tipped the balance, though, for you to issue that urgent note warning of stagflation in the U.S.?
Thank you, Kathy, for having me. Since this month of April, we have seen the deeper than expected tariff escalation between the US and many of its major trading partners. So that led various forecasters, including the IMF, to downgrade the growth forecast for the year, especially in the US, which they are now looking at below 2%. After growing by nearly 3% last year. Likewise, the high tariffs that US imposed would be inflationary in nature within the United States, and that is leading consumer inflation expectations in the US to spike to multi-decade highs, not just for the next 12 months, but over the medium term. And as a consequence, there are fears of slower growth and higher inflation, which the combination would be a stagflationary environment. So that's why we had this note that takes into account this economic phenomenon that is not common, but already has occurred in the global economy during the 1970s when there were oil price shocks. And even as far back as during the 1930s, when the US also had their restrictive tariff policy that exacerbated the Great Depression.
True, and those were really nasty historical economic ills, if you will. So you did account for the IMF downgrade that happened overnight, but what about whatever happens at the G20 finance ministers and central bankers huddle happening now in Washington, D.C., and also the PMI readings in Japan and Europe, that's going to come out in the next 24 hours, and the Fed Beige Book. I mean, all those are stuff that you still have to consider for maybe a potential downgrade even? I mean, what are you looking for in these first readings that would show the impact of the first month's tariffs across the world?
Expecting a further erosion on the PMI readings, especially in the United States, because the leading indicators in the first 3 months and even just this month of April are pointing towards a downward trajectory. And therefore, the growth forecasts that we have currently are still facing more downside risks because of the heightened trade policy uncertainty that is not yet fading, and also the heightened market volatility that is still prevalent within the United States and also in many other markets around the world. So these two have been causing some dampened sentiment, and also businesses and investors having a more cautious and wait-and-see tone, which could weigh on their investment spending plans for the rest of the year. And even consumers, which have been already facing more fears of higher future inflation, would likely pull back on their spending plans as well.
Base case scenario then, stagflation in the U.S., what will that mean to the Philippines' own growth and inflation trajectory then?
Globally, we are expecting slower growth, so that includes the Philippines. So we trimmed our GDP growth forecast this year to 5.9%, coming from 6.1%. Also, we have recently lowered our inflation forecast for the year to 2.7% from 3.2%, suggesting that we are not in a stagflationary environment because the US is the one that is imposing the hefty tariffs. And since they are a big player in the economy, the effect of that would be higher prices in the United States, but potentially lower prices in the rest of the world. You will have bigger surpluses of goods that ought to be entering U.S. Economy, but are now parked elsewhere So that more supply will result in lower world prices, and that will benefit importing countries such as the Philippines.
Okay, which leads us then to the interest rate differential. How critical is that going to be for the Banco Central to keep as wide as possible with the Fed funds rate if Powell were not to relent and just keep rates on hold in the States?
The interest rates differential is very important, but the timing of navigating through the adjustments in monetary policy will also be equally critical as well. So since the BSP has already cut by 25 basis points, we still expect our local central bank to continue monetary easing with a couple of more rate cuts. And we expect the second 25 basis point cut in June and the third in August. So for us, our view is a back-to-back rate cut scenario with a baseline view that the Fed will still cut at the latter part of the year. In fact, the market is currently pricing in between 3 to 4 rate cuts in the United States because of that growth slowdown expectation, despite the fact that US inflation is currently still above the 2% target of the
Okay,
Fed.
we'll keep tabs of that. Two more back-to-back, or at least a back-to-back rate cut from the Banco Central. Thank you so much, Angelo Taningco of Security Bank, joining us from the trading floor.